Welcome or welcome back to my channel, McNallie Money. Today we're going to be taking a dive into the world of personal finance, specifically how to build a budget, personal cash flow statement, income statement, and financial goal setting. Before we get into it, please take a second to like or subscribe if you haven't already, and let's jump right in. So to kick us off today, guys, we're going to open up with a quote from Benjamin Franklin. Some of you may have heard this before. It's one of my personal favorites. If you fail to plan, you're planning to fail. And really what this talks about is success doesn't happen by chance. It's not luck. It's the people that put in the work. It's the people that have goals, and it's the people that stick to the plan that really prevail in life, become successful, and achieve what they've set out to do. So I think this sets the stage here. Now, as we talked about in the opening, budgets really coincide with the start of the year. A lot of people tend to make budgets or personal goals in the first month of the year, New Year's resolution, and generally those tail off as the year progresses. Obviously right now with COVID, gyms aren't open in a lot of places, but many of you who do go to gyms on a regular basis will notice January is the busiest month of the year, and then it traditionally tapers off February, March, and by April, gym capacity is pretty much back to what it was. So I think this is a good place to start. I think this is a good mindset to have as we're talking about budgeting, because ultimately budgeting is planning, and generally you're planning to hit certain milestones or goals, which we're going to talk about later in the video. So to open up with, we'll get into the actual budget itself. Now, I don't think anything here is groundbreaking. Hopefully you guys already have a personal budget that you use. There are a few things I'm going to point out, tips and tricks that I've kind of learned along the way, but the budget itself isn't the meat and potatoes of this video. What we're going to talk about afterwards in terms of saving rates and your three levels or three personal goals, I think that's where the value of this video is really going to come in. So to start off with, and before we can get into that stuff, we need to talk about budgeting. Now, the way I like to think of this, very similar to company analysis, is cash flow statement versus income statement. If you start by looking at income statement, I guess the second component here, for most of us it's fairly basic. Now this may change depending on your personal situation, if you have rental income, if you have a side hustle, a second job, things like that. But for the vast majority of listeners, it's probably going to be your paycheck, maybe one or two other sources of income. Ultimately, the goal for myself is to come up with 5 different ways to produce income. Hopefully most of those are passive, but as of right now, I'm currently sitting with a few rental properties, my daytime job, and hopefully in the near future, YouTube. For argument's sake and for the demonstration here, I have not used real numbers, but I did use a lot of examples that I have in my own personal budget. So we'll start off with income and then we'll jump over to expenses. So in this example, income, paycheck from your job is $4,400 per month, which means you take home about $2,200 every other week or every pay period. If you work that out, roughly, depending on your tax rate and where you live, it's going to be about $65,000 to $75,000 a year of overall or gross income, which nets out to $4,400 a month. In addition to that, I've put in some rental income in the example here, and this doesn't necessarily mean a rental house, but in this scenario, I was thinking maybe you rent out a room or you split rent with a friend, girlfriend, wife, whatever the case is. So overall, for income, you're looking at $5,150 per month net. Now, if we take a step back here and we go over to expenses, this is where I think there are a couple tips and tricks that I can hopefully help share with everyone. So as I mentioned, it's pretty straightforward. You should just be able to list out all the different ways money comes out of your account in a month. Mortgage is probably the biggest. If you don't own a home, this would be rent. However, in the example, I've put this at $1,800, which is kind of the going rate in Calgary, Alberta, which is where I live. After that, property tax, utilities, so that's going to be heat, power, water, that type of stuff. Home insurance, or it could be renter insurance, condo insurance. TV, internet subscription. Many of you may not have a TV subscription. In Canada here, we do pay a little bit more than in the States, so this comes in close to $100 a month. Subscriptions, so this could be things like Netflix, Amazon, Disney Plus, whatever the case is. The point I wanted to make here, you'll notice this is only a $15 a month fee. A lot of people, when they're making their budget, will only look at the big expenses, and I think that's doing yourself a disservice. The point of budgeting is to know where every single dollar goes and to account for those dollars. So no matter how small the expense is, I would make a point to put it in here. And that's why I wanted to include that subscription service. Parking, fortunately for me, with work from home right now, is free, so that's great. I still have put it in because many of you will have a parking payment each month, but for myself, I put free. Home security system keeps the wife happy, keeps me feeling safe when I'm out of town. Car payment, we're a single vehicle family, so we just have the one. Groceries, which works out to about $150 a month, so I did use $600, which is pretty close to our actual expense for that one. Entertainment, gas, and cell phone. Again, a lot of times people won't account for things like entertainment or gas. I would put it in there personally, and if I were building this budget for myself, I would break those categories out into exactly what I'm spending on entertainment-wise and groceries, stuff like that. If I'm eating out at restaurants, I would break that out so I know exactly, again, where my dollars are going. Now, I've put all this stuff in red, and I'll explain that in a second here. You'll also notice there's some expenses in yellow. And the reason I've differentiated those is because in my mind, it's important to understand expenses that are going for lifestyle or liabilities and expenses that are going towards investing activity or assets. So you'll see here everything in red. The color indicates, I guess, a negative. These are going towards liabilities or expenses that don't necessarily produce income down the road or set me up for my future saving goals. They are necessary, they are important, they need paid, but they don't necessarily lead to those goals. The yellow section here is actually money that I put away each month, and again, these are fictitious numbers, but for the purpose of the example, we've used stock account, pension, and extra mortgage payments, and these actually do contribute to your net worth or your overall savings goals from a high level. So in the example here, I use stock account. Maybe you put $150 a month into your trading account. Pension, you could have this through work, or maybe you have a standalone pension plan. And extra mortgage payments. This is something I would highly encourage people to do as they become homeowners, or if you're already a homeowner. Many mortgages will allow you to put it up to 100% of your monthly payment as an additional payment each month, and that actually goes 100% to the principal. So this is a very quick way to pay down your mortgage, avoid interest payments, and if you do this at the very start, it compounds throughout the term of the mortgage, and it can definitely shave years off the term. So I put those ones in yellow. You'll see below I've done a total for each. So in a given month, again, in the example here, we have $4,120 of red expenses, meaning they come out of my account, but they don't necessarily contribute to net worth or savings goals. The yellow comes to $750, so you can see obviously that's a smaller portion of my total expenses. However, those do go into net worth calculations and savings goals, which we'll talk about in a little bit here. So between the two, we're looking at $4,870 a month. Now, if we compare that to the income of $5,150, you can see my monthly cash flow comes out to $280 a month. So in essence, what we've created here is an income statement and a cash flow document rolled up into one, but this shows me exactly what money's coming in, what money's going out, what portion of that is going towards investment opportunities, and what I have left over essentially for fun money or rainy day. Now you can see here, $280 out of the total doesn't look like a lot, but when you do actually account for all the specifics, such as groceries, subscription, entertainment, things like that, the $280 really is excess money, and it shouldn't really be earmarked for anything if you've done your budget properly. So that's what I'm going to call a traditional budget. And like I said, many of you may have this. The main point I would make there, the devil is in the details. Make sure you get into the specifics. Don't sell yourself short. Don't round down, because at the end of the day, you're doing yourself a disservice. Now, the piece that I think is interesting here, and not a lot of people actually put in, is the savings rate. So what you can do, and this is why I purposely separated this section, is if you total up the yellow, which are going towards what I would deem to be savings, you could maybe classify a portion of your mortgage that's going towards principal, but for argument's sake here I haven't. You get $750 a month. Now if you take that $750 and you divide it by the total income, you actually get a savings rate of 15%. So for those of you who may read about financial education or personal growth, development, stuff like that, generally the rule of thumb is anywhere in the 15, 20, 25% of your income per month should be going towards saving and investing. Now keep in mind, we're talking net income here. So if you were to compare this to your overall earnings or your gross earnings, it actually comes down closer to about 11%. Personally, I wouldn't settle for anything under 15%. We'll see in a second why. But again, this depends on your personal situation, the amount of income, the amount of expenses. It may take you a while to set up your situation to get into that 15, 20, 25% range. Personally, the goal for myself is to be above 40% savings rate each month. Now, if we jump into the next section here, this actually goes into savings goals. So having a budget is great. This helps you get visibility and understand where your money is going. But ultimately, the budget is meant to set you up for whatever your future goals are down the road. So the way I've laid this out is 3 different scenarios. What I call secure, comfortable, and prosperous. And the way I've set these up is spend some time thinking about the lifestyle that I want to create for myself and my family, what that lifestyle looks like, the things that we'd have, the trips that we'd take, the items that we'd buy, the cars that we'd drive, things like that, and really visualize 3 different scenarios. So in my secure example, this is basically making ends meet. This would be working a full career, retiring comfortably, maybe not going on all the different excursions, trips, expenditures that I would like, but at the end of the day, we'd be secure, the family would be taken care of. Comfortable, that's what I'd call kind of the middle class scenario. You're going to be able to do some of the things that maybe you wouldn't be able to in the secure situation, eat at some nicer restaurants, drive some nicer vehicles, take nicer vacations, potentially live in a nicer home, maybe retire a few years early if that's what you're looking for, but kind of that middle of the road scenario. Prosperous is what I'd call moving up into the upper class, upper middle class, wealthy cohort of the population. And this is where you're really going to be able to enjoy life, splurge, buy some of the fancier things, and really get the most out of your life and provide for your family. Again, the numbers I've used here are examples, but I think they paint a pretty good picture. So the age categories I've used is a 20-year span from age 30 to 50. Now you could expand this if you're younger, older, whatever the case is. You could do a 10-year, 20-year, 30-year. I'll show you in a second a great website for planning this stuff out. But for argument's sake, as of right now, I'm 31 years old. I decided to use even numbers, so I started with 30. Then the second column I've done is the actual year. So you can see your age in relation to the calendar year. Now I've started plugging some numbers here just for argument's sake. And the numbers I've chosen in the secure section is a $10,000 current balance. Comfortable is a $20,000 current balance. And prosperous is, once again, a $20,000 current balance. There's a few variables we can play around with in here, and I'll walk you through each example just for full visibility. So the first input is what you currently have in the bank. So this would be your starting principal or your starting balance. Again, as mentioned in the secure scenario, I've used $10,000. Now, annual contribution, I've slated as $6,000 a year, and where this number came from was actually on my budget sheet. So if you take a look here, stock account and pension, this adds up to $500. If you multiply that out by 12 months, you're looking at $6,000 a year of savings. Again, I have not included mortgage in this, similar to mortgage up here, because I look at your primary residence as a fixed asset. You need somewhere to live, you need somewhere for your family to reside, and you can't easily liquidate that or use it to buy a trip or car or whatever the case is. So for this example, I've used stock and pension as my savings, multiplied that out by 12 months, and that's where the $6,000 annual contribution came from. So you can see here, you start the year with 10,000, you put in 6, at the end of the year you end up with 16. So what we've actually done here is added in an investment return percentage. So in the secure example, I've used 5%. So you can see here, we multiply the principal by 1.05 or 105%, and then you'll layer in your annual contribution. So you can see we put in 10, added 6,000 throughout the year, that gets us to 16,000, and then we add in the 5% of the initial principal. As you go through the years, you can see the total balance go up due to these two variables. Number one, the annual contribution. Number two, the yearly rate of return. So in the secure example, you can see if we were to put in 10,000 today, add 6,000 or 500 a month for the next 20 years at a return of 5% annually, you'd be sitting with just about $250,000 at the age of 50 or after 20 years of saving, which is a fair chunk of money and realistically not very difficult to get to if you have some level of savings that's proportionate to your level of income. Now in the comfortable example, things go up from there. So here I've used a $20,000 initial balance, and I've said we're going to start contributing $9,000 a year. So a 50% increase from the secure scenario, or an additional $3,000 a year, which if you think about it, really isn't a ton of money if you break it out over 12 months, but it can make a big difference, as we'll see in the numbers. So in this scenario, the other variable I changed was the rate of return. So I've now gone up to a 7% annual rate of return, and let's see how it looks after 20 years. Now if you work through the numbers, you can see here we're just under $500,000 or $455,000. Now where it gets really exciting is when we start looking at the third scenario, or the prosperous. Again, I've started with a $20,000 balance. We've now put our annual contribution up to $12,000, so another 3 on top of the comfortable, or double what we were saving in the secure. So you'd now need to save about $1,000 a month, and we've put our rate of return up to 20%. Now, you're not going to get 20% for most investments or ETFs or mutual funds. This is going to take some active management. You're going to need to know what you're doing. You're going to need to be picking some great stocks and having good success in the market, but it's definitely not out of reach. I know a lot of people that average 20, 30, some even 40% return annually. You're going to have your ups, you're going to have your downs, but if you can average that 20% a year, that's going to tremendously increase your saving potential and the amount of money that you ultimately end up with in retirement or at the end of the day. So again, if we take a look over the 20-year period, we now see that we're growing just north of $3 million. So although the annual contribution doesn't seem to go up by too much, $3,000 between each scenario, the rate of return is really what drives these overall increases and overall difference from the secure to comfortable to prosperous scenario. Now, as mentioned earlier, this is just example purposes. I've used even numbers. Everybody's going to be in a different situation. Everybody's going to be starting the year or today or whatever the case is with a different amount of money, different saving potential, and a different rate of return based on the investments that you have. So the third and final thing I wanted to show in the video is just a way to quickly calculate this stuff for yourself. Now I've actually plugged in the numbers used in the prosperous category here, and you can see the 3,007,008 actually is exactly what's showing up in the calculator. So if you haven't used this website before, very helpful. They have a number of different calculators you can use. This one's the compound interest calculator, and the website's called moneychimp.com. So all you're going to need to do is put in your current principal, the annual addition, the number of years you want this to grow, interest rate, when you're going to be compounding the interest. So at the start of the year, throughout the year, each month, or at the end of the year, and when the payments will be going in. So for the argument's sake here, I've said end of each compounding period is when we'd put all $12,000 in. In actuality, we'd be putting in $1,000 a month. We'd be compounding it 12 times throughout the year. You can see the total changes quite dramatically depending on the variables that you put into the calculator. Now let's, for example, go back to one compound period each year. This gets us to our $3 million. Now, if we were to give this 30 years, so let's say you're 30 right now, you're retiring when you're 60, watch this number jump. We go from 3 million all the way up to 19 million. Now, those kind of numbers seem absolutely unrealistic for a lot of people when you think about sitting at the end of the day after your career's done with nearly $20 million in your account. But realistically, people do this, and people make these kind of plans and achieve these type of goals day in and day out. What it takes is the planning, the dedication, and the follow through. Now, maybe you're not looking to retire with $20 million. Maybe that's not realistic for you. So let's take a quick peek if we plug in just our secure scenario here. So $10,000 a year, $6,000 annual addition. We'll keep 20 years to grow with a 5% return, and we get our $224,000. Now let's say instead of retiring at 50, you're going to retire at 60. Even in this base case, you can see we're now close to $450,000. Now if you're going to retire at 65, like most people do, and you're around the age of 30 right now, that means you have 35 years to grow. You're going to be just under $600,000 plus the equity in your home, because remember, we didn't include any mortgage payments or additional mortgage payments, which is a pretty nice retirement considering this would be cash or cash equivalent investments that you could now start drawing from and using to pay for that lifestyle you, your family, your wife, your friends, whatever the case is, wants to live. I hope you guys enjoyed this video. I hope you understand the importance of budgeting and goal setting and how these two can be used together to set up future plans down the road. If you did enjoy this video, please make sure to share, give it a thumbs up, and subscribe to the channel if you haven't already. And make sure you have a great day. Thanks.